Right, similar example as the one before then, fair value of NCI with an impairment. As usual, we will kick off with an SFP question with S's equity table. S's equity just has share capital and retained earnings in it in my questions. 3 columns as usual, year end, acquisition, post acquisition, simple, straightforward. The year end you just take straight from the question, 100 and 500, and the at acquisition for share capital you always presume it's the same. Then you go looking for the retained earnings at acquisition, which are 80, and so therefore you have made 420 post acquisition. You know your equity book value is 180, which is the same as your net assets, but you want the fair value, and the fair value at acquisition is 190, so you need to make a 10 adjustment. You then need to find out what's it caused by. It's caused by PPE, so you've got 10 to depreciate over how long? Over 5 years. So 10 divided by 5 is 2 per annum. I bought it 2 years ago. I will have 4 depreciation in total. That leaves me 6 at the year end to go put onto S's PPE, like so. Once I've done that, I can just add this down to 416. I can then go and get on with my goodwill working, which is the fair value of consideration. It's the fair value this time of NCI, because it tells me it's the fair value method, look. And the fair value of net assets acquired, I always get from here, because it's the same as the fair value of equity, which is 190. I being H, paid 200 for my share 60%. So I paid 200, and NCI, they gave the fair value, which was 84. Okay, so that means goodwill then must be 94 before any impairment that's happened since, but then there's been an impairment of 10, and because this 84 here, because it includes more than the net assets, it also includes some goodwill as well, so they're going to get their share of that 10 impairment as well. So goodwill though is 84. I can start off my group accounts up here. I can just take the investment in S and now call it in the group accounts goodwill of 84. So I then go on and I carry on and I do my NCI. NCI using the fair value method is always at acquisition, add on any post acquisition, take off any impairment, and I've got my answer. The at acquisition is always the same as what I used for goodwill, which is 84. Post acquisition, well here's my post acquisition column. I need a percentage of that. I need to remind myself what percent. Well, we own 60, so NCI will get 40% then. So I'm going to need my calculator then. So 40% of 416. So 416 times by 0.4 is 166.4. 166.4. Less any impairment. Yes, they do get some impairment, so they will get 40% of the goodwill impaired of 10. So they will get 40% of the 10, which is obviously 4. It's an impairment, so it's a cost. So 166.4 plus 84 minus 4 gives me 246.4. And I can go and put that now into the equity part of my group accounts. NCI 246.4. Final working, and then I'm done, is retained earnings. So retained earnings, I want all of H, so I just need to go and find all of H, 1,500. I don't want all of S though, I just want my share, which is the other 60% of the post acquisition. So 60% of 416, let me calculate that, 416 times by 60% is 249.6, less any goodwill impaired, again just my share, so my share is 60% and it was 10 because I remember, so less the 6. Plus 1,500 then, minus 6 equals 1743.6. Put that in there, 1743.6. 1743.6. Share capital we know is always H, and then we simply add across any assets and any liabilities, so that would be 2006. Then we can add it up then, so that's 2090, isn't it? So all this should be, get your calculator out and cross your fingers and your toes, 100 plus 1743.6 plus 246.4 equals 2090. Take it home and give it a kiss.